In the world of investment and trading, Nasdaq has always emerged head and shoulders above all other exchanges around the world, especially for retail traders who are looking for high growth opportunities, the potential for disrupting technologies that may redefine entire sectors, along with the possibility of exponential growth in share price. Many companies also began their adventures here in order to become the titans of tomorrow, such as Apple, Amazon, Tesla, and Alphabet. With all this glorious history, it is normal for many traders to continue navigating the exciting and yet volatile and dangerous waters of Nasdaq in order to identify a precise way to capitalize on what's going to redefine tomorrow's economy. After all, this is one of the key birthplaces of the modern economy based on the connectivity, speed, and analysis used by the new era. Amongst all the titles that may bring us wealth and prosperities, here lies Palantir, the data analytics firm based in Denver, Colorado, and has been an enigmatic company ever since it went public on Nasdaq, with a reputation shrouded in mystery and controversies. As a data aggregator and analysis platform, it has one of the deepest relationship pools that Silicon Valley can only dream of with the public sector entities for large contracts in healthcare, defense, and intelligence analysis. Its price action is directly linked with the company's own fundamentals and risk appetite of the market, and with an increasing institutional participation in the company, there may be a lot more potentials where the share price might go to. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. Over the past few days, Palantir has been holding steady around $17.40 mark, showing a slight decline of approximately 5% in the last 5 days and a 10% dip over the past month. These short-term fluctuations may not be overly significant in the grand scheme, as various factors beyond the fundamental aspects also contribute to those movements. The year-end period tends to be relatively calm for the stock market, with fewer traders and less news circulating around. Despite this, Palantir has maintained its overall bullish trend, showcasing an impressive performance throughout the year. Looking ahead in the upcoming 2024, there could be fundamental challenges arising from the main street. Given that Palantir's clients are predominantly stakeholders in the real economy, potential cuts in individual budgets for research and analysis may add up. However, Palantir has demonstrated its capacity to not only turn a profit and to be self-sufficient in cash flow, but also to ride the waves of trending topics like artificial intelligence and large language models. Of course, the actual profitability of those ventures remains uncertain. From a fundamental perspective, Palantir has undeniably generated momentum in the market. As we navigate the dynamic landscape in the coming year, we should definitely keep an eye on how Palantir continues to adapt and capitalize on the emerging trends. With that being said, here's what the technicals are showing. The trading volume of Palantir has been around 14 million shares compared to the average volume of 60 million shares. Over the previous 52 weeks period, the price fluctuated between $5.84 and $21.85. The volume of shares traded tells us how many shares are being bought and sold at any given point in the market, and if there's enough liquidity to support a trading strategy. If the float is thin, it would be very easy to influence the stock price, but also difficult to exit. When we compare the current volume against the average volume, there might be the possibility for a trend reversal or breakthrough if the difference is very large. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Palantir is currently at around $38 billion compared to the enterprise value of $15 billion. As we compare the current price to the historical price fluctuations, the stock is 3% higher than the 1 month low, 24% higher than the 3 month low, and 200% higher than the 52 weeks low. On the options level, which often gives a hint on the market sentiment about where the stock price is likely going to look next, the implied volatility here is at 51% compared to a historical volatility of 49%. The put-call volume ratio is currently at around 30%. It is normal for most stocks to also tend to have a higher put option volume than what they deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 106,000 contracts a day versus the 30-day average volume of 288,000. In terms of open interest, the most recent volume of open interest is around 2.9 million contracts versus the 30-day average of 3 million contracts. Regarding the shareholder structure, institutional owners hold about 40% of the current float, including those who are short selling or lending to the short sellers. The big shareholders include Vanguard, Renaissance, and BlackRock. Typically, it's recommended to see some institutional presence when you want to hold a stock for the long term, because it offers a layer of stability and reliability in the medium to long term. It means that overall the market believes that this company in particular can deliver value in the long term, which is an important factor to consider for the investors. I personally consider the minimum threshold to be around 25 to 30% for institutional ownership, although there are many exceptions to that rule, as there will always be great companies mostly owned by retail traders. The current short interest is around 6% of the total float, 53% of which come from the dark pools. Typically, if the short interest is above 15% of the total volume, we can argue for a potential for short squeeze. At 6%, that is not the case. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. To conclude, my personal impression is that Palantir will remain relevant in the years to come, despite the uneven volatilities that the stock is having right now due to arbitrary circumstances. This is why a position can be gradually accumulated over the years, and I believe that we should choose to ignore the short term price volatilities, may it be to our favor or not. Doing so assumes that the portfolio has the appropriate risk appetite for tech stocks as well. So, I would recommend to commit between 3 to 5% of your portfolio in Palantir, to split the allocation in batches of 20% at a time over the next 24 months so that you may purchase more in case there's a retracement.